The following paid commercial program is brought to you by TD Wealth.
Welcome to Money Talk. I'm Kim Parley. Thank you so much for joining us. Earlier this year, TD Asset Management announced that its affiliate, Epoch Investment Partners, would take over the management of its main U.S. blue chip equity fund. Well, that change has happened on November 1st, and with the name changing to TD U.S. Capital Reinvestment Fund. And the two people now heading the fund are David Siino, Managing Director and Portfolio Manager and Senior Analyst, and Stephen Bleiberg, Managing Director and Portfolio Manager, both at TD Epoch. And they're joining us from New York. Gentlemen, it is lovely to have you both with us, and I'm looking forward to the conversation to find out a little more. Stephen, if I could, I'd like to start with you. This isn't the first time that I've spoken with somebody at TD Epoch, so I do know the importance of cash flow, and that's something that has always been very important. But maybe you could just tell us, remind us why you have that emphasis on cash flow over earnings.
Sure, Kim, and thanks for having us. I think the best way to start is to tell you a story about my first day in business school, which was many, many years ago at this point. But I remember the first day of my introductory finance class in business school. The professor went up to the board and he wrote two words on the board. And the two words were time and uncertainty. And he said, finance is the study of how we value uncertain cash flows over time. And I think that's still the best definition of finance I've heard in all these years. Now, accounting is something quite different, and accounting is what produces things like, an earnings per share number. But accountants have a kind of a different view of the world than that finance view of the world, as we would call it. So, for example, if I run a company and I go out and I build a factory, and I spend $10 million to build that factory, the accountant will say to me, well, how long is that factory going to last? And if I say 10 years, the accountant will say, okay, great. So we will charge $1 million a year for 10 years against your revenues, because accounting has this thing called the matching principle, where they're trying to match up revenues and expenses over time, which is fine. It serves a certain purpose. But if you're trying to value the business and understand whether this company is doing well or not, it matters. The timing of the cash flow matters. It's not going to be $1 million a year going out the door for 10 years. That $10 million went out the door today to build the factory. And so the timing of cash flows matters. That's why you should focus on the how a business generates cash flow and also what they do with it. So our philosophy is basically, sort of twofold. Number one is it's the ability of a business to generate not accounting earnings, but free cash flow that makes it worth something to begin with. And then equally importantly, it's what management does with that free cash flow that drives the value of the business up or down. Meaning if they can either, broadly speaking, either reinvest the cash flow into the business or give it back to the shareholders. If they're going to reinvest in the business, they should really only be doing that if they can earn a return on that investment that's greater than the cost of that capital. And when they run out of opportunities like that, the best use of the cash flow at that point is give it back to the shareholders, because they always have other things they can do with the money.
We're just bringing up the chart now we have here about the founding principles of TD Epoch. As I mentioned, the free cash flows you talked about, and you were just talking about the ways that cash flow can be deployed, whether it's reinvested in the business or paid out to shareholders. So much of this, I know, though, is, when I've spoken with you and your colleagues in the past, too, is about, finding the cash flow is often very related to the quality of the companies that you look at. And quality, I know, is something that I believe that you think is important, but is often, quote, mispriced. Maybe you can tell us a bit about that.
Sure. Well, quality in the investment business has traditionally meant three particular statistics. I mean, there are things like quality indices, and the way the companies that provide those indices determine who goes in is they look for three particular statistical characteristics. One is high return on equity. Second is low leverage, because one way you can boost your return on equity is if you just go out, borrow some money, buy back some stock. The business hasn't changed, but now there's less equity, so a given level of profit will mean a higher return on equity. So the way you kind of prevent that from happening is, in terms of defining quality, is you say, yes, high ROE, but with a low leverage. And then the last thing that's usually used is earnings growth stability, or stability of earnings. And our view is those are all nice things to have. And the companies that David and I look at in the fund that we're managing tend to have those characteristics. But to us, that's not enough. we think quality means more than just those statistical definitions. It has to do with two more things. One is what we were just talking about, that how does management allocate capital? Do they understand the principles of sensible capital allocation, only reinvest when they can earn good returns on capital, otherwise return the money to shareholders? And the second one, and I think more important, is we're looking for businesses that have what we would call, a sustainable competitive advantage. Sometimes people call it a moat. You want a business that is not just earning high returns on capital today, which to us is sort of the best measure of quality and profitability, but it's companies that do have some unique attributes to their business that are going to enable them to continue to earn high returns on capital going forward, regardless of sort of what happens in markets. Sometimes you see companies in, like energy or commodities type companies where when the price of the underlying commodity goes up, their returns look good for a while, but they are not really in control of that. They're kind of at the mercy of the markets for setting the price of those commodities. And when the price inevitably comes down at some point in the future, their returns immediately deteriorate. So to us, that quality means that you have something makes you unique, gives you pricing power, so that you can control your margins, control your returns on capital.
All right, stay with us. When we come back, we're going to continue our conversation with both Stephen, and we'll bring David into the conversation, talk a bit about how this actually comes to light in terms of choosing what goes into the fund, and also the conversation about what stays in the fund. You are watching Money Talk. We'll be right back.